Welcome back, everyone. I'm Ruby Nguyen, and this is Shark Tank. Just kidding, this is Zero to X, where we tell real story about entrepreneurship. And today, we're going to settle one important debate once and for all. Bootstrapping or venture capital funding for early stage startup? Which path is better? Actually, the real question is, which path is better for you? And so to bring this debate together are two extraordinary entrepreneurs I've known who have both excelled in each of their chosen path. First is Phillip. He's a co-founder of Homebase, a PropTech startup backed by Y Combinator. Phillip has raised more than $30 million in venture capital funding and debt funding. He's also an alumnus of Harvard Business School, Goldman Sachs, McKinsey, and LinkedIn. And to put up a good debate with him is no one better than Stephen Turban. And Stephen is the co-founder of two bootstrap businesses with 80 employees under his management, Lumiere Education and Leverage Assistant. Stephen is also an alumnus of Harvard College, and he dropped out of Harvard Business School. He's also an alumnus of McKinsey, so you two have a lot of common characteristic, but you chose two different paths. By the way, Stephen also writes a lot about being a bootstrap founder on LinkedIn, and his LinkedIn is blowing up on this topic. So welcome to this podcast today. Thank you so much for being here. All right, here's the opening. Bootstrapping or VC funding? Why did you choose your path? And how is it more aligned with your long-term vision as an entrepreneur? Phillip?
I think for me, when I look back to the initial decision, I don't think it's actually much of a dichotomy, as in you choose one or the other. For me, when I first moved to Southeast Asia, I had the vision of building a business that would make tangible societal impact, across millions of people. And that's why we ended up starting this company called Homebase. And the goal at Homebase is actually to make homeownership accessible for, millions of people across Southeast Asia, right? And fundamentally, when you look at our business model, what we do is we work with financial institutions like, family offices or debt funds, and we have to build, very sophisticated AI-based technology to be able to underwrite, various financing for home buyers. And then we have to be able to really scale this out, right? When you look at the fundamental business model of what we do, it almost kind of necessitates this infusion of capital, right? To actually accelerate the business and to be able to scale out your impact. I think, for us, if we had chosen perhaps a different business model, or gone down a separate path, maybe, we could have considered bootstrapping. But in regards to the exact kind of mission and the scope and the scale of what we wanted to do, I think, that's why fundraising and raising capital for us was the right choice, right? And over time, I think we've been quite fortunate to have various great, partners and investors to help us really scale our business, to reach a lot of people and build the business from there. So that's the high level, and then happy to dive a little bit deeper then.
Sure, we'll keep the details for later.
Yes, exactly.
How about you, Stephen? Why did you choose this path?
Yeah, so for me, I think one of there's this expression I really like from this entrepreneur called Andrew Wilkinson. Yeah, he's I'm a bootstrap founder, and one of the things he says, which I really like, is that if you want to build a rocket ship, you first have to build a launch pad. And that's kind of how I thought about it, where for Lumiere and for Leverage, I think we both started, actually, I think probably like a year younger. I was like 26, 27, right when we started. I felt like, I want to learn. I saw it more as a dojo, like a learning dojo, than I did as something that, I don't think I had like some big dream, to be honest. I wasn't like, I'm going to change the world in this way. I was like, I want to create a dojo for myself to practice the art of being an entrepreneur. And I felt like for me, a better dojo would be one where I didn't have kind of the influence of outside capital. So that was a little bit why I felt like, if you create a cash flowing business, then it creates a launch pad for you to then do additional things. And I'm not saying I would never raise money. And I definitely think to Philip's point, it's really about the model. The companies that I've run, Lumiere is a good example. The cash flow dynamics are pretty positive. So you don't have this upfront development cost. You don't have to give out loans.
Yeah.
You have someone like a student who pays a tuition, and then you hold that money for a few months, and then you pay off a percentage of it to essentially a tutor. And so that means that you, from day one, have these positive cash flow dynamics. So that was exciting for me. I think there's a bit the business model allowed me to be bootstrapped. But also, I think I chose the business model because I wanted a business model that would allow that. So it was definitely give and take. And a couple of years later, I see that, once you get to a certain stage, I think actually it's all kind of the same, actually. Once you have enough cash flow, then you can do things at a venture capital backed company could do, and vice versa. But yeah, for me, it was about building a launchpad. That was like my initial decision.
So it's actually initially it all based on your vision and what you want to build in that business.
For me, it was what I wanted to learn.
What you want to learn.
Yeah, I was more like the learning orientation as opposed to like an output orientation.
I see. For entrepreneurs, you're both learning on the path that you've chosen. And I'm curious what the learning would be, even though you haven't taken the opposite path. But in a VC-backed company, what is the biggest learning that you have and the leverage to that learning? And same question to Stephen, actually. Yeah.
Yeah, that's a really good question. We actually agree a lot on, a lot of common points, because when you talk to the really great venture capital investors, they don't say that fundraising, that's not the hard part of running any startup or any business, right?
Yeah.
The actual hard part is actually just building the business itself. And if you actually have built a real business, you can show the numbers, you can show the traction, you've created a great team, you have created an amazing product. Like, that's actually the hard part, right? And if all of those things are true, then you go out to VCs, you can fundraise in a week, right? And people will give you millions of dollars and a lot of leverage to be able to kind of put yourself behind that vision, right? So I think the core fundamental thing in terms of what you learn, whether or not, you actually raise capital, or whether or not you're even doing a tech-based business, right? Some people operate restaurants, right? And operating a restaurant in Vietnam is also super, super difficult, right? Because there's so many logistical and operational challenges, and working with people is super difficult, right? But that's actually probably the biggest learning, right? Consider, okay, if you're looking at a venture-backable business and you do have to, do certain things and, have certain learnings, I would say there's like maybe 2 or 3 main things, right? Number one is, if you actually have to work with investors, you have to learn really how to sell, right? Sell not only yourself, but sell the company and sell the vision of how you're going to change the world. As opposed to maybe a bootstrap company, you have a little bit more control about, okay, this is actually what I want to do, and you use that to actually run the business and, kind of scale it. For the investor, you really have to sell, why is this business going to fundamentally change the world, right? And if you are lucky enough to get kind of that capital and get on that trajectory of like hyper growth, right? Suddenly, you have a lot more leverage and basically capital behind you, right? So learning how to allocate those resources, right? If you have millions of dollars, like, how should you actually use this to actually increase your growth, right? How can you use this to actually, go up to the next level, right? And suddenly there's a lot of pressure for you to grow in a shorter amount of time. And I think learning how to deal with that pressure and manage that pressure is also significant as well. And then I think the last thing is, if you do have ability to actually do a fundraising round or those kind of things, there's a lot of like other investor considerations or kind of more like legal considerations and those kind of things that you really have to be able to be familiar with, right? And in terms of how you structure the financing, what type of financing is actually most beneficial for you, right? Some people actually, if you raise debt, it's actually better for them as well, right? So learning all of these complexities, I think, has been quite helpful, not only on the capital raising side, but also in terms of how we fundamentally run the business and how we're able to scale our impact across Southeast Asia as well.
That's a great answer. Stephen, while Philip was sharing his perspective, I see that you were agreeing, and then sometimes you were looking a little bit skeptical. I would love to learn what was the skeptical part.
Yeah. Well, I do think you learn. So I think that the premise, I totally agree that as an entrepreneur, you're essentially just a learning machine. Like, your whole role is to learn new things and systematize them and then scale them. And that could be through tech, that could be through people, that could be through like capital, etc. But I was thinking, I have a good friend of mine who's also ex-McKinsey. She was my colleague at McKinsey, and she runs a agriculture company in Kenya called Farmark's, a really cool company. And she was describing to me how she has this issue where her drivers will siphon off gas. They'll steal gas from her trucks. Wow. Right. And so she had to learn, how do I make sure that these drivers in Kenya don't siphon off gas and steal gas from me so I can cheaply deliver tomatoes. Okay.
That's crazy.
So she's learning, right? But one thing she was reflecting on, I thought was really funny. She was like, why am I learning this? You know what I'm saying? So it's like, just because you're learning doesn't mean it should be the thing you're learning at, So I do think that there's like, I was like, yeah, probably you don't want to learn that in life. Like, this probably doesn't matter that much for any other company you might build. Maybe it does, but she wants building Kenya and whatnot. So I do think there's different things you do learn. Like, I think as a bootstrap founder, you definitely don't learn how to raise capital. You don't really know how to hang out with VCs or talk to them. Like, I think you also learn a little bit less of like vision setting, I would say. Because I think there's something about, to Philip's point, of like what my sense when you're raising capital, I haven't raised capital, is like you'd say, hey, here's like the vision of what I'm doing. You don't need to do that as much when you're bootstrapped. You can just be like, actually, we're just running this thing. Like, it doesn't need to have vision. I'm just running it. But what you do learn, I think, on the flip side is I think you learn the value of money a little bit differently, because that money is like literally yours. And so like you make money. Now you have like $1,000 in the bank account. You could just give yourself that $1,000, or you could invest it back in the business. So now this money actually has a real value. And I think that creates slightly different dynamics in terms of how you think about who to hire, whether or not you hire ahead or hire behind your needs. Like, and this is another thing that you do learn when you're bootstrapped, but you also don't learn. So at least I found that when you're bootstrapped, you really generally tend to hire after you have a need. You rarely hire before you have a need. And so you don't experience this kind of like, oh, I know there's going to be this need, let me go and hire a bunch of people. You might do that, but usually you push until you realize, well, I do have this need, and you hire. That's a little bit more capital efficient. So you learn how to run something to more capital efficient, but on the flip side, I would say probably less learnings when it comes to like vision setting, and when it comes to things like leverage around capital. So it depends what you want in your dojo. You know what I'm saying? Like, what is the thing? For me, I want like the dojo of like business. You know, like so that's a little bit different than the dojo of like maybe like entrepreneurship. I feel like it's slightly different.
I see. You know, great stories from both sides of you too. And you mentioned a little bit about the vision setting. Yeah. From my personal experience, I feel like the vision always evolves, even in a VC-backed company or whichever company, the founder just evolved that vision along the way, right? I even talked to a founder, right, in my personal experience, that the vision on the first day and then a few years later is the same. So I'm not sure if a VC-backed company or a bootstrap company would have a different way to build a vision. I think it depends a lot on the founder of the company. Sure. Whether it's bootstrap or VC-backed. For sure. This is a personal opinion.
Yeah. A good question I have tonight, Phillip, is like, do you find that if you say one vision and then you go into another round of fundraising, do you have to keep that vision consistent? Or is it like each point of fundraising, actually, you can kind of say whatever you want and people don't really have like a memory? Like, well, I'm doing this thing. And then the next round, like, oh, I'm doing this thing. Are people like, what the heck? Or people like, whatever, like, as long as you're successful.
I think usually in, VC-backed businesses, like in the very beginning, if you just, are just starting out and you're raising your pre-seed round, it's very much more about the vision and the team, right? Because honestly, there's nothing there. There's no traction, there's no numbers, anything like that. So it's more around the vision of how big can this be, right? And if you're actually in the later rounds of fundraising, like Series A, Series B, Series C, it's at that point, it's more around, this is the business that you actually have, this is the numbers that you have, and you're letting your numbers tell the story. And as you get later into growth rounds and more like private equity style rounds, it's more just around financial metrics and comps and running DCFs and all of these financial analyses and models, right? Because it's a quote unquote real business, right? So I would say that as long as you actually have the numbers and you're building real business and customers love your product, like that's actually the most important thing. Because everything else around that is like very fluffy. Maybe the exception right now is like with these AI businesses, people are raising $1 billion valuation. There is no product, right? Yeah. So that's more like, oh my God, this vision is really going to determine your company. But I think short of that, I think it's a very, very, much more around, these are the tangible metrics. Yeah.
That makes sense. So both stories make sense. Now I would like to maybe have some fun with you guys. So I would like to hear Phillip give some critique about the bootstrapping route. Right. And then the same thing to you, Stephen. Who want to go first?
I think going back to the initial point, I don't think there's any, critique at all, because there is no right or wrong answer in terms of this is the one way to do it. And I think fundamentally, again, it goes down to this is the type of business I want to build, this model I want to build, and these are the kind of lifestyle requirements or whatever that I want to have, or this is the control I want to have, right? And so, if I steelman the VC backable case, right? What I say that is really strong at is if you really want to have a big vision that fundamentally changes the world and you want to apply the maximum leverage to be able to do it, right? I love the word leverage, partially because Stephen's company is called Leverage. But, this concept of leverage, there's various forms of leverage, right? There's a guy from Naval, Ruby Nguyen. He has this very famous podcast called How to Get Richer Without Getting Lucky, right? So he says there's 4 types of leverage, right? One is labor. If you have people working for you, that's leverage, right? One is capital, right? If you have millions of dollars to invest, that money can go to work for you, right? Instead of you actually having to invest all your own money, right? Another one is, computers, like, data, software, and those kind of things, right? So there's various forms of leverage, and capital is part of that leverage, right? So if you really want to, let's build a, billion-dollar company, a very world-impacting company in the shortest amount of time, you have to actually have things that help you work while you sleep, right? Whether that's people, whether that's, capital, whether that's, business partners, right? And I think raising capital helps you facilitate that, right? Not only in regards to be able to convert that capital into labor and hiring people, but also, aligning the right business partners, right? I would say that, for us, some of our investors have been really, really helpful to the success of our business, right? And obviously these investors are very incentivized to help us because they own equity positions on our cap table, right? So if they were just an advisor or they were just very, being nice, maybe they can do one favor or something like that.
Yeah.
But because they literally own parts of your business and shares, right? Suddenly they're really, really incentivized to work very hard. And I would also argue the same as employees as well, right? And that's why in startups, you share these very, I would say, like legendary stories about people sleeping in the office and those, because they literally own parts of the business, right? And it's the same thing with, if you have a baby, right? You're going to take care of your baby a lot more than if you're just babysitting another kid's, another parent's baby, right? You're really, really incentivized to push the success of this company. So I believe that that's probably the best side of, being able to actually really align with the business and go from there, right? On the other side, right, on the bootstrap side of things, I would argue that that path is not for everyone, right? And it's also not sustainable for everyone over a long period of time, because imagine if you're keeping on doing that, unless you're like the Elon Musk, right? You can't really do that over 60, 70 years, right? And it's not very sustainable. But, if you look at a lot of the other businesses, like, it's nice having a lot of control. It's nice having the ability to actually set the vision and, hey, I want to take a vacation in Malta and, take off for 3-4 weeks, then you can do that, because in a bootstrap business, you have the full leverage, you have the full control of what you want to do, right? Or if you don't want to scale it anymore, or if you don't want to, let's say, have to push the IPO or, drive to M&A, a liquidity event, that's also possible for you as well, right? I would say that there's no right answer to exactly this is what you should do. It's just more around what is the path that you actually want to take, and then which model makes the most sense from there. Yeah.
Awesome answer. And so I just want to make it short. In terms of critic, you don't have a critic for the bootstrap model, but you do see a difference between having the financial leverage in a VC-backed company where bootstrap founder don't have. And then Stephen, what is your critic for the VC-backed path? And while Stephen is making his argument, I would love to ask Phillip to think about, or maybe share with us the challenge that most people don't know before they take the venture capital path.
So I think I've been writing about this a lot recently. I think that there are two fundamental flaws with raising venture capital. So the first big flaw is that, from the founder's perspective, is that it creates really difficult incentives for you if one of your goals, it depends on your goal, but if one of your goals is financial outcomes, financial freedom, it creates very difficult dynamics, because most venture capital rounds, if you raise money, you tend to raise with something called preferred shares. So like, let's say I raise $20 million. So now these $20 million, they're usually, not always, but usually they'll go back to the venture capitalist first. Now that creates an interesting dynamic, because you might have a cash flowing business that's worth $30 million, but if you sold, now $20 million first goes back to the venture capitalist, and then you have some percentage remaining of your $10 million. So there's a lot of scenarios where you raise round after round after round, your total chunk of the pie, especially if co-founders, goes down to, like, one of my good friends, raised like $30 million recently, has 14% of the company. Next round, probably like 10% of the company. Like, they'll be worth $300-400 million, so that's still a ton of money. But he's beginning to have less and less and less of the pie, and he's having a higher and higher cliff that he'll need to hit in order for him to realize any money. Now, why is that bad? I mean, it's not bad if you ultimately sell, but there's kind of two big issues with it. One is that you might not sell, so you end up with nothing. And the second is that, like, we live our life, right? So it's not as if, like, life is about accumulating money until the very end and goes the biggest number wins. It's like, actually, your lived experience is one that you have over the whole period of you running the company. And if you only get to experience it at the end, it's kind of a shitty thing to do, I think. The second thing I don't like about venture capital is that sometimes it really makes sense to raise money. A lot of times it doesn't. But the thing about venture capital is that it has this flywheel effect of creating publicity, which makes it cool, which makes it a type of permission. So one of the things that I was writing about recently is around doing accelerators. Now, accelerators can be good if you don't have an idea. I know Phillip, you did an accelerator, and but Phillip was like super helpful for me starting in the era, someone I really admired and I do admire. And so like, I think it's Phillip, but if you have an idea, I see a lot of people like, oh, I have this idea. Let me go to an accelerator. And the accelerator is usually, now it's a little bit of capital, but usually it's just structured permission for you to do a thing. And so the accelerator say, hey, yeah, I'm going to give you the structured process for you to get started, but I'm going to take a big chunk of your company. And then I'm also going to start you on this clock of creating that cliff structure again. So I think a lot of people use venture capital, not because they actually have a business model that requires it, but because actually they think it's like a form of permission. It's like, oh, your mom, dad, I started a company because now look at this like cool VC with a cool office that's really expensive has told me that I'm an entrepreneur. Like, I just don't think we need that. And so usually I think the juice is not worth the squeeze, particularly if you're a founder who has someone who has a credibility themselves. Then you can hire good people regardless. If you don't have any credibility yourself, like maybe because of your background or whatever, raising venture capital could be a good signal for you to hire good people.
Actually, that's a chicken and egg. If you don't have any credibility, it's very hard to raise venture capital.
It is a chicken and egg. Yeah, exactly. So that's why I think is raising venture capital always wrong? No, definitely there's some good times to do it. But I think that just watch out that you are creating a scenario where it's much less likely for you to end up with money that you can actually use for your lifestyle, which is I think the point of money is usually for you to do something with it, have fun with it, or to give to other people. And also you might just be seeking out permission, usually permissions.
But while Stephen give really good critics for, founders choosing the VC path for the wrong reasons, right? I would love to hear from Phillip. Would you agree with what he was saying? What is the biggest myth you've heard about people who don't raise venture capital having these critics about this path?
I agree with some points, and I think I have slightly different opinions on others, right? So I think the 2 points that you mentioned is around, let's say, like net worth or capital optimization, right? And then the other one is probably around permission kind of ability to be able to build a certain business, right? So I'll respond to both of those. So I think on the second thing, on the permission part of it, I would argue that, yes, I agree that, some people, some entrepreneurs, maybe they need a safety net to drop out of school and those kind of things, right? But I would actually argue that those are probably the, not kind of real entrepreneurs, right? In regards to if you need like a permission of a venture capital investor to be able to do something, that's more like a corporate attitude, right? It's more like, okay, my boss supports me, therefore I should start a business. And, if you have that mindset, it's almost like you're doomed to fail, right? But the flip side is that, there are fundamental businesses where I would say it's very, very hard for me to be able to bootstrap, right? I'll give you one example. Any type of enterprise B2B sales, right? Yeah. If you don't have, let's say, executive relationships with VPs of these big billion-dollar businesses, then it's very, very difficult for you to be able to go through that 6-month sales cycle and sell an ERP solution or sell a CRM solution, right? And if you try to bootstrap that and compete against VC backable businesses where they do have leverage to be able to iterate faster on product features, they have VCs to be able to do customer introductions, I would argue that, it's very hard for me to be able to succeed, right? And then if you look at the B2B market versus the B2C market in anywhere in Vietnam, it's, 1,000 to 1, probably like that, right? So, yes, there are certain segments that I think do make sense where you can actually do that bootstrapping. But now, the world is a competitive place, right? And, the easy opportunities, I think, they're very competitive, right? So if you are competing with a company that has leverage in terms of capital, they're able to build more products, they're able to iterate faster, they're able to get customer introductions through venture capital investors, I don't think it's about permission anymore. It's about scale. It's about actually being able to enter these markets and actually competing and winning, right? And long term, I really have this view that the world works in kind of a power law distribution of outcomes, right? What that means is that the top 20% will achieve 80% of the results, right? And how does the top 20% do that? They have access to more resources, they have access to better connections, a better network, and those kind of things. I think it applies to outcomes in wealth, in distribution, and in startups, everything like that, right? So I think that I would say is the nuance around startups and entrepreneurship as well, right? The other thing I think is around maximizing wealth, right? And I think the mentality or the attitude and the framework I think about that is that, it's better to actually be able to really drive a significant outcome first then worry about wealth later, right? Because I think if you really, really want to maximize your net worth, the advice I would give, your viewers is go into private equity, right? Or go into something like, like start like a, business that actually really generates a lot of money and a very stable cash flow, and your expected value is, very stable, very high, right? And if you want to get wealth that way, great, right? But, part of the allure of running a startup is that you're really able to actually work on, and maybe this is slightly different, right? But you're willing to work on this vision that you really fundamentally believe in and you have fire in, right? When I was at Harvard Business School, a lot of my peers, they did this model. Instead of starting their own business, they did something called like a search fund. So fundamentally, they raise a pool of capital and they'll acquire a more traditional business, right? Like an air conditioner cleaning business. And then they acquire that business at a, 3x EBITDA, right? Multiple. And then over time, they'll actually apply leverage to grow to a 6x EBITDA. Maybe they'll actually, roll up various businesses and sell it to a private equity fund, right? So, that risk profile fundamentally is very, very low compared to actually starting a new business and, trying to scale it out, right? But it's more secure, right? But again, the trade-off there is that you really have to go into a very niche, like a niche business, right? One of the most successful businesses, and doing that model is like someone like acquired an egg carton manufacturing business, right? So for me, I'm not so passionate about doing that, right? You can make a lot of money doing that, right?
Yeah.
So in terms of secured outcomes, I would say, there are various ways to actually be able to get rich. I'm the big believer where if you really do believe in something, if you're passionate about something, if you think it will really benefit the world and it's something that you have unique leverage and ability to do, I think the wealth will come. And so that's kind of the way that I think about, like money and stuff like that, as opposed to kind of optimizing for financial outcomes, in the beginning, and then we'll go from there. Yeah.
Great arguments. Stephen, I would love to hear about what you think is the biggest myth that people have about bootstrap business.
Yeah, I think the biggest myth, or the term I really hate, is this idea of a lifestyle business. If you're running a business and you haven't raised money, that you are running a business that's created to support your lifestyle. Now, I think that's totally reasonable. And in fact, I would say, like, almost definitionally, all businesses are like kind of lifestyle businesses in some way. Like, they're supporting some type of lifestyle. But the lifestyle you want is like, runs a big company, maybe it's like living at the beach, whatever.
Yeah.
But I think the implication of the term is that you're doing this thing kind of just for your own gain. And your gain is that once you achieve like some like peak lifestyle, like you're living in Malta or wherever, then you kind of tap out because like that's the only thing that matters to you. So I think often implies a sense of like lack of ambition, maybe even laziness, or like maybe kind of like a hedonistic like desire just to like get as much as you can to enjoy your own life. So I don't like the term. I think it's nothing wrong with running like a business that's for your lifestyle. I think that's great. But I don't think I think the misconception that I really don't like is that if you don't raise capital, then you must be running a business that's not ambitious. That's really just to, for your own, like, lived experience so that you can go like, take a month off and go party somewhere. So I don't like the term lifestyle business. And I think that's just like, to me, the big misconception is that if you're bootstrapped, you can't be ambitious. But there's a huge companies that are pretty much bootstrapped. Like Microsoft is bootstrapped. Like Microsoft did not go through the venture capital rigmarole. They're really bootstrapped. I think like IBM's another decent example. Didn't raise that much capital over time. So there are a lot of actually really big businesses, very ambitious founders who themselves didn't take a lot of money in because luckily they hit on a business model that allowed them to scale up using their own cash. So I think that's probably the biggest misconception. I would say.
Yeah. Chào những khán giả của Zero to X. Mình muốn dành một chút thời gian để cảm ơn Workflow, nhà tài trợ của tập podcast ngày hôm nay. Đội ngũ của mình tại Curious cũng đang sử dụng không gian tại Workflow để làm việc hybrid. Cả đội rất yêu thích kiến trúc hiện đại, đồ ăn ngon và những ly cà phê đầy tính sáng tạo ở đây. Điều tuyệt vời nhất là bạn có thể đăng ký sử dụng không gian linh hoạt với chi phí rất là kinh tế. Nếu bạn đang tìm kiếm một không gian làm việc hybrid cho bản thân hoặc cho đội ngũ nhỏ của mình tại thành phố Hồ Chí Minh thì hãy thử Workflow nhé. Next part, I would love to understand how you think about risk. So as an entrepreneur, you always have to think about how you manage your risk in the business and also in your own life, right? So how do you manage financial risk in your personal life? The personal financial risk and also the financial risk in your company, Phillip.
I think in both models, financial risk is actually, something that is very similar, right? I would argue that maybe in a VC-backed business, if you do have funding, it allows you to take more calculated risks, right? And I would say maybe one example of that is Amazon, right? Where even if they have a really successful core business, they were able to basically do these really crazy ideas, right? Like starting AWS, starting Amazon Echo, starting, all of these other business lines, right? And doing these calculated risk and really reinvent yourself or reinvent the business. I'm not saying that, like in a bootstrap kind of business, you can't do that, but maybe having a little bit more capital and runway to be able to experiment allows you to do that, which, I find quite interesting as well. In regards to other things where, we're talking about financial life, financial risk.
No, wrong way.
Yeah, and those kind of things, right? I think in the beginning in any type of business, like you probably shouldn't be paying yourself, right? If you're just starting off and you have no revenue and those kind of things, part of accepting VC funding does that, allow that, even if, let's say, you're not generating a net profit as a whole, you can actually start paying yourself, you can start paying employees. So in some sense, maybe that does help you deleverage, right? As opposed to maybe you have to wait until your other kind of business is generating a lot of profit, then you actually have capital to be able to put yourself. And then at that point, the question is, should you pay yourself more? Or should you actually use that to expand your business because your cash flow that you have is relatively limited, right? So maybe there is a bit of constraint there as well, right? But, in terms of personal finance and personal finance risk, I think in any kind of business owner, any kind of entrepreneur, you're investing your most valuable resource in your business, right? And that's your time, right? And that's your effort. So I would argue that for most people, like unless they really, really kind of believe that this is 1,000% going to work, right? I would argue that, a lot of people have other types of investments, right? Whether it be in stock, whether it be angel investing in their friends' businesses or, other types of ways to generate cash flow as well, as opposed to, just, so diversification, I think is pretty important as well. But maybe that's in a separate kind of conversation for.
Yeah.
Stephen, how about you? How do you think about financial risk in your business and your personal life?
I think this is a bit of a hot take, but I think running a startup is super not risky. Like, I actually think it's total bullshit. Everyone talks about like starting a company, even bootstrapping a company, all these things being risky. I think it's not risky at all. I think, what's risky? Doing a PhD. That's fucking risky because what's your outcome? You're probably going to go to like University of Iowa and to the next 30 of your life in like Des Moines. And then maybe you're not going to get tenure and then you're going to be an adjunct faculty member, like balancing between high school. Like, that's actually a really risky path. People doing a PhD, that's a very risky thing to do. Running a startup, not that risky. Particularly if you have like a background where you have like some credentials and maybe like, you can get a job if you fail in a few years. Like, I generally don't think it's that risky. I think it's really risky to want to start a startup and not do it because then you run the risk of like living a life of regret. Like, that's fucking really risky. For me, that's very risky, Starting a company, what's the worst that can happen? It doesn't work in a few years. You didn't make any money. Maybe you lost some money, but you're still living. You're probably, especially if you're doing your 20s and 30s, you're still relatively young. Like, you can go on and do your own thing. So I generally don't perceive that much risk in it. I think it's overblown.
In fact, even for like our company, right, when we talk about hiring, was like, we would rather hire someone who has started a small business, even if it's like a clothing store or even like a cafe, but they fail, right? But, I'd rather take that than someone who has just worked in a corporate job because they know the ability to actually, like do their own thing, right? And I know that they have this mindset and they have this appetite for risk. So it actually even makes them even more employable, right? And I actually wrote a blog about this as well. Like in the old days, if you take a risk, you start a business and you fail, you're like ostracized from society, right? Yeah. You have no other opportunity because failure is really bad. And I think maybe in some Asian countries, that's still the mentality. But if you look at Silicon Valley or, to some extent, I think Vietnam is actually adopting that attitude as well. People say, oh, wow, you took a risk. Great, right? Here's the next round of capital. Unless, you do something like you stole money or, you stole the crypto coins, whatever is that, right? Yeah. But if you made a good effort and you tried your best, like, no, great, right? Here's the next chat. Let's go. Yeah.
It's exciting the world we're living in now. Actually, starting a startup is not risky anymore. According to you too, I have a little bit of like just a different perspective on, not different, but add-on perspective on this. I think it's still risky for inexperienced founder because, the start is there I think for non-VC backed startup, is 7 out of 10 new businesses fail. And for VC backed startup, it's even higher. It's about 9 over 10 or 10 over 11 companies fail. So looking at that stats, and it's just purely a company failing is closing down, right? Just look at that perspective, not accounting the learning and, the next thing that you're going to do is going to become more successful. Then, yeah, there's some risk in there. But as an entrepreneur, I also agree with you that this risk is actually very manageable. And once you take it, it's actually a game that you enjoy. And so, yeah, it will return to you in one way or another, either the learning or the network that you've built. And most entrepreneurs are successful in their 40s, usually the third or the fourth company. So all of that is actually not risky. So great talk on risk. Next, I would love to learn a little bit of like a story. Maybe I should have taken the bootstrapping path and vice versa for you, Stephen. Philip, have you ever thought about it?
Yeah, I mean, again, I would say that for us, the type of money company that we build almost like constrained us, right, to this one path, right?
Yeah.
But, what I do look at, there's obviously a lot of now like Twitter influencers and stuff, and I don't know how real these are, right?
Yeah.
But, or I do know friends who they started these like ChatGPT extensions. They live in like Bali, and then it's like a one-man business. And they're generating, $2 or $3 million in cash flow every single year. And then they work like 2 or 3 hours a week. Despite kind of the negative connotation of being a lifestyle business, I think that type of lifestyle is great, right? You're generating $2 or $3 million of cash flow. It's a one-man business, right? Mm. And I think, now the mentality around VC is also shifting as well. Because, before, and I think in more Asian societies, it's still true. But before, if your mom asks you, like, hey, how big is your business? Like, so often they're not, talking about GMV or cash flow or those kind of, they're talking about employees, right? Yeah. Before, the mentality is very much like, how many employees do you hire? Because labor is a kind of metric for success, right? And now the mentality around VCs and thinking is very much around like, how efficient is your business, right? Instagram sold when they were 13 employees for $1 billion, right? So that is very, very efficient as a business. And so if you apply the leverage of AI technology in the future, and if you try to get companies to the most efficient size possible, maybe you actually have one person who's running $1 billion business in the future as well, right? Yeah. And I think if you can apply that and you don't need, let's say, capital, right? You can actually use that to finance your business, and you have ultimately control. I think that's amazing, right? You don't have any employees you have to worry about. You can choose wherever you want to live. You can choose what you want to do. You can shut down anytime. Like no one's telling you to come into work. I think that's actually the ultimate definition of success, right? Mm. But obviously, there are some barriers that preclude that right now. So, we do have a ways to go, right? But I do think that if you do have the ability to build that type of business completely bootstrapped with no investors, and you sell the business and 100% of it is yours, like that's the dream, right? That's amazing. Yeah. So I think that's my answer.
Mm-hmm. How about you, Stephen?
Yeah, all the time. The one, because I'm like a weak ego, I'm saying fragile little ego that wants people to like me. And I see these TechCrunch articles and it's like, this person raised this money, this person's doing this super sick thing. And then I had a friend of mine recently who got, he runs like a similar kind of education business, just got profiled in the Wall Street Journal. He's like, this guy's raised all this money. And I'm like, like,
no, glamorized, right?
Like, where's my article? Like, no, it's so, yeah. I do think that that's, by the way, that's real. That's not like a joke. Like, that's real. Like, you feel it. You're like, fuck, why does no one think what I'm doing is cool? And when you're bootstrapped, you're just kind of grinding in the corner, doing some stupid little thing on your stupid little business that, like, honestly, is kind of irrelevant to most people's lives. And so people ask you, what do? You tell them, they don't give a shit. In general, that's true. You ask anyone, they tell you, usually they don't care. That's totally fine. But they really don't care when you're doing this, like, bootstrap thing in the corner. So, yeah, I think there's a nice thing there, that there's like some grass is greener for sure. And I think it's nice also to have, I don't need this, so it's not so important, but I do think it's always nice to have structured like mentorship and support, like talking to a venture capitalist who has some pattern matching of like, oh, I've seen 30 companies, what's happening to you is normal, here's that experience. If you can recreate that as a bootstrap founder with other founders who are in your space and learn from that, but that's something you definitely miss as well.
What is your definition of success as an entrepreneur, including the financial success, but not solely financial success?
Well, I think it depends. Like, there's many seasons to life. So I would say I can only speak about my current season of life. For me, the season of life that I'm in, like, success would be learning a lot, becoming a better entrepreneur, and building up just a set of frameworks around of like how I can build something chunky in the world so that when I want to go off and do it again, I'll be that much better, that much faster doing it. I think, you know, I'm actually not that motivated by money. It jokes about it a lot, but like for me, money is just like, I think if you want to optimize for it, it's great. It's kind of a fun scoring system. Like my life is pretty simple. Actually, I don't have that many things I like to spend money on. I grew up like having an abundance of money. Like my family wasn't super rich, but my family never like lacked. So I was never something where I was like, oh, I really need money. There's never been a motivator for me. So I think that's a fun scorecard. For me, it's not that important, but it's kind of fun to kind of compare. But I think if you learn a ton from me, that's really great. And then you build a team that you like and you have fun with and, you know, that you think are go off and become your competitors. I that's also cool.
That's cool. How about you, Phillip?
Yeah, I mean, I think apart from money in terms of the professional side, I think it's just you have to work on what you want with the people who you want to work with, right? And I think that's just very simple, right? In regards to if you want to change the world and build something that's very impactful, great. If you want to work on your own environment and it could be a social justice or NGO cause, great, right? It could be working with a small business. It could be working, you know, adopting cats, right? Whatever it is, right? There's, you know, and I would argue that money is not involved at all, right? Because if everyone is optimized for money, they would all go for like private equity, right? But that's actually not the metric or scorecard that I think one should pursue. I think it's actually the latter, and money will come as a byproduct of that, right? And I think the other thing, there's a quote I really like, which is a fit body, a calm mind, and a house full of love. These things cannot be bought, right? So these are three other components in life that I think that are very fundamental to you even being able to strive for anything else or making money, right? So a fit body, your physical health, right? Because there's another quote I like, which is, you know, a healthy man wants 10,000 things. A sick man only wants one thing, right? Which is physical health, right? A calm mind, because there's a lot of very unhappy, miserable people who are very rich, right? Go to Wall Street. I'm sure you'll find tons of people who are like that. They have millions of dollars, they have a house in the Hamptons, but their private, you know, personal life is a mess, right? So you want a calm mind and then a house full of love, right? You can't really buy love. So, you know, I think these are the more fundamental aspects that we should all strive for and have to have that foundation in before even if we worry about money in.
Before we end the episode today, I would love to hear everything that we talked about today, putting in an elevator pitch. So for Stephen, if you are pitching a founder to follow the bootstrapping path, what would you tell them in maybe less than 1 minute?
So if you want to build a rocket ship, build a launch pad. Best way to build a launch pad is to learn how to do the fundamentals of business. That means understanding a P&L. That means how to hire people. That means getting product market fit. The best way to do that is not to inject outside things. It's just for you to grind away until you figure it out. You can always raise capital later, but there's no better joy than you creating something that is 100% from you. And then you can enjoy it along the way. So don't be a doctor. Don't waste your life. Like spend 20, 30 years like studying something only to go a plastic surgeon in the end and make a bunch of money when you're 50. That's lame. Enjoy your life throughout it. I think there's no better way than to bootstrap. So
Beautiful. Thank you. Phillip.
I would say that the ultimate quote, if I really have to compile everything together, is basically build the life that you want, right? And obviously this is a very esoteric kind of overall life philosophy, but I think it really depends on also the business that you want to build, right? So we talked about this dichotomy of raising capital, and that allows you to do certain things, right? Make a big impact in the world or change a fundamental social issue. And the benefits of raising capital and finding the right financial partners that allow you to realize that vision in a very short amount of time. But building the life that you want could be also determining that your values are more indexed on your personal control, having more time to spend with your loved ones. And that is completely valid as a life than, you know, really changing the world and making tons of money as well. And if that is actually the path that one wants to take, then I would argue that you should choose that as well. So I think overall, there's no one right definition of success. There's no one right definition of this is the type of business I want to build, or this is the method I want to build the business by. It's a personal decision of know yourself, of this is the lifestyle I want to lead, this is the impact I want to have in the world, this is the time I want to spend with my family, and you know, whatever, right? It's about knowing the consequences and the trade-offs of both paths, and then making an educated guess and decision, and you know, with no regrets, and just going from there. So yeah, build a life that you want, I would say.
That's a beautiful way to end the show. thank you so much for the conversation today. I know I put you guys in a tough spot because I asked you to argue and debate very hard for your position, but I know that the real world is not like that, right? It's actually a lot of nuance. You know, as an entrepreneur, you can be successful in both paths if you actually choose that path, know the consequence of it, the pros and cons, the price you have to pay, and then just stick to that path, make your decision right? So there's no right path for anyone. And so the message to the audience is, yeah, listen to their pitch, but choose what is right for you, because there's no right path for everybody, just right for you. So thank you so much for being here today. I really enjoyed this conversation.